Okay, mic check. I'm on a mission to help traders recover from a blowup. My one mission is to inform traders like, hey, you blew up because you lost control of your size and your scale. You don't know how to size and scale. Everything else is basically the lowest hanging fruit, like picking direction, thesis, and structure. How do I know? Because I myself have chased the wrong thing and the true thing. The ultimate thing, the thing above all, is size and scale. If you blow up, it's because you either did one error or the other in these two categories. You size too big or you scale too fast. That is it. The reasons why things happen will vary, but the foundation, the first principle of everything is size and scale. So a stock is going to move up or down. Whatever you're trading, it's just going to move up or down, especially if it's highly liquid. The reasons why it moves up or down or trade sideways will change. And so change is the only constant in the reasoning why. That's why your thesis, it's like you can lose edge in trying to predict markets, trying to be right, because the reason that you were right the last time is going to change from the reason why you're right the next time. And the reason why you're right the last time is going to be the reason why you're wrong this time. And so change is the only thing. And so at the root of everything, whatever you're trading, if it's highly liquid, is gonna do its own thing regardless of your participation. Period. And the reasons of why it moves up or down will vary. So the reason is useless. The fact that it moves up or down is what's important. So for instance, the last market crash was for a different reason than the next one's gonna be. But the fact that the reality is markets crash. And so focus more so on the reality of what happens. That's the foundation of trading. So you're focusing, hey, this stock is going to move, period. It's going to do its thing, period. How do I capture value from that moment? And how do I capture value out of that, out of this movement without blowing up? And I can only blow up if I ratchet up my size too big or I scale too fast. So structure is more important in terms of your reason, your thesis, how you structure your trades, how your risk reward, because that determines um that's the beginning foundation of how you size and scale. So I have found so many positive EV strategies that I've blown up because I sized them too big or I scaled them too fast. Literally. It's like you're trying to get to the hospital, right? And you're driving super uber duper fast and you're not in an ambulance. You're driving super duper fast trying to get to the hospital, speeding, and you crash. Or police come after you and they try to stop you simply because you're moving too fast. So ultimately, my mission is to help traders slow down. Hey, slow down. And how do you slow down monetarily? Size and scale. Slow down. That's how you blew up. But the reason why you ratcheted up your size and your scale is because of your desires. Like you want to make money fast, or because of greed. Like because the only reason why you would size up is because you think this is an opportunity to go bigger. Now, it could be like, well, whatever reason is motivating you, that's gonna change. But ultimately, the root of the problem is size and scale. Um, there are a lot of strategies out there that like just pick a random strategy. Like um if you structure it properly, you can likely create edge because there's always a winning side to a trade. When you lose money, somebody else makes money. So whatever is triggering you entry, like that's irrelevant because whoever the which is aka the market maker, whoever's taking the opposite side of your order, they don't know what triggered you entry. They don't know. They just gave you, they accepted a structure that you will lose in the end if things don't work out in your favor. And so I say that to say that take any situation, any thesis, any idea, anything at all, you can establish a structure that creates positive expectancy. And the evidence of that is the fact that you lost doing the things that you were doing. Somebody else made that money. They took the opposite side of your trade. And so they structured the trade in such a way that they made money. And so the thesis, the trigger of entry is literally irrelevant in the grand scheme of things. But in any type of field of uncertainty, um, direction, like choosing direction is literally useless. That's why when you hear like, I remember all the time when I'd read about um old time um traders, they were called stock pickers back in Warren Buffett's day. And they're like, man, any monkey could choose a stock and outperform, money managers, right? Well, that's because the value of picking direction and being right is useless. So the structure is more important. So the structure means when you're wrong, how much are you wrong versus when you're right. And then from there, the only other thing that matters that'll dictate your long-term success is how you size and how you scale. If you have a positive expected structure, then sizing and scaling is the only thing left. That's it. But if you take a perfectly positive expected value structure and you size it way too big, it'll blow up. If you scale it way too fast, it'll blow up. So how do you stop blowing up? Stop sizing too big or scaling too fast, aka slow down. That's the only message. Slow down, trader. Slow down. Slow down. You don't got to go there as fast as you want to. And the thing is, fast is slow in reality of compounding. If you really want to get there fast, you compound and you let the math take you there. It's like effortless growth, but you can't compound effectively without proper size and scale. This is a core teaching from the Blow Up Recovery Protocol.